Content is intended to provide accurate information, however, is not intended as financial, tax, or legal advice. Please consult a financial, legal, or tax professional for specific information regarding your individual situation. Opinions expressed and provided are for general informational purposes only and should not be considered a solicitation for the purchase or sale of any security.
Cornerstone Retirement Partners presents Your Course to Retirement with Grand Rapids Certified Financial Planner Ron Corser and Nolan Gosley. Cornerstone Retirement Partners are planning today for the potential of tomorrow.
And welcome into the program. This is Your Course to Retirement with Grand Rapids Resource for a common sense approach to your money, your investments, and your financial and retirement planning. He is Ron Corser, CFP, founder of Cornerstone Retirement Partners, helping to make the complex financial world a little easier to understand. And Ron, we always appreciate the perspective, guidance, and education.
Good morning, Peter, and good morning to everybody listening to today's program, either in the comfort of your living room drinking some coffee or on your way to church. It's just a reminder, you can tune in to today's program by going to our website, www.cornerstone-rp.com. That's www.cornerstone-rp.com. You can tune into today's program and a whole library of previous programs. And for those of you who are regular listeners, if you have any questions, it can be on what we're going to talk about today's program or something that's gone on in the economy this past week, and you want some answers, give us a call, 616-301-2581. That's 616-301-2581. Or put your information in on a website, www.cornerstone-rp.com, and we'll reach out to you and get you the information you need so that you can always, as usual, make great financial decisions when you have all the facts in front of you.
And I concur, a wealth of knowledge, information, and resources available at your fingertips, ladies and gentlemen, right there at cornerstone-rp.com. Tools, reports, calculators, informational pieces on just about every topic and subject. You can certainly peruse the library of podcasts and videos on specific topics that are of interest to you or that you have questions about. Cornerstone-rp.com, or you can give a call if you have specific questions that you would like to answer and address for your circumstances. 616-301-2581, 616-301-2581. Today's program, Ron, no exception. You have a great report here. Simple, 2 pages, 8 moments to move your money. And I think a lot of people have questions about when they should actually take action, make proactive moves with their money. This report sums up maybe not a complete list, but 8 of the biggest, most common, most beneficial moments to consider moving your money. Ron, do you think that this list is important because a lot of people do have questions about these?
Yeah. People have questions about it, interestingly, but sometimes people are just primarily buy and hold people because they work with an advisory firm that's primarily buy and hold. There's nothing fundamentally wrong with that strategy. But given the turmoil that we've seen and experienced the past 8 to 12 months, sometimes taking a look at your accounts and saying, is there a reason that I'm doing what I'm doing and have been doing for the last 3 years, or is there something I need to be doing? So we talk about rebalancing. There's a lot of reasons to rebalance your portfolio, your investments. And keep in mind that why would you want to do that? What if you've been successful? You know, last year was a pretty good year in the market. You made some money. This year, not so much. And generally, what we hear from a lot of people, a lot of shows, magazines, will just stay the course. But there's a couple times to rebalance. Number one, if you've had a good run in the market, and you may have had some stocks or funds, exchange traded funds, what have you, that have made a lot of money, you may want to say, you know, these things don't go up forever. They're still good to hold, but I think I want to pare back my position in that, take some profits. I tell people, we invest for a reason. We invest to make money. And so taking profits on things that have had a nice run up is not a bad strategy. You can always buy more later, but basically if you come into a a time in your life where you have an investment strategy that's laid out with different asset classes and what have you, and you put it together, say in 2018, and it hasn't changed. Well, has anything around us changed? And I think the answer to that is, yeah, there's a lot of things that have changed around us. I wonder if it'd be a good idea to take a look at my investments line by line, so to speak, and say, is there places where I can take some profits? Are there some places where maybe I've had a loser or taken a loss and I can sell that at a loss to cover some of the gains that I may have had? We do a lot of that tax harvesting, particularly in the fourth quarter, but there's no wrong time to do that. There really isn't, because it always opens up opportunities down the road to do different things. So when to rebalance is really up to you. Should you rebalance? I absolutely encourage everybody to do it periodically. Now, what does periodically mean? It doesn't mean every day. That's timing the market. But maybe every quarter, every half year, certainly every year, you got to take a look at what you own, how it's done, how it's performed. And here's the other reason. In investing, there's an ebb and flow. This year, energy as a sector has done reasonably well. And if you didn't have a position in energy last year, or much of a position, maybe you want to increase that position now, because it's your opinion and your feeling that the energy problems that we have are going to continue to keep the price of oil up in a good way. So there's a lot of reasons to do that. I encourage people to always take a look at what you own, why you own it. Is it doing what you want it to do? Is it time to take profits? And that's a very difficult thing for investors, to sell something that's gone up, because we always think it's still going to keep going up. Some of them do. Some of them do. We can look at the incredible meteoric rise of Tesla from 2019 to this year, when its share price went from, I checked it went from about $48 a share to over $1,000 a share. It's gone back. There's a lot of volatility there, but it's never a wrong time to take a look at your portfolio, trim some profits, trim some losses, rebalance given on what's going on in the world. And here's the other reason to think about doing it. Maybe your life has changed. Maybe you're a little closer to retirement. Maybe you're not getting the income you need off of your portfolio the way it's configured. These are other reasons to take a look at making some changes to rebalance, and I encourage everybody to do it on a regular and frequent basis. And it doesn't mean that you have to, every time you look at it, you have to make a change. It's really important to look at it to make sure you don't need to make a change. Does that make sense?
It does. And also of note here, Ron, I know we're talking about this report of the 8 moments to move your money, but this one is within the current accounts. We're not talking about relocating or repositioning whole accounts to different locations. We're talking about within the account, money on occasion should move around. It's one of the fundamental principles of long-term financial success is regular rebalancing.
Yeah, that's a good way to look at it. Instead of moving your money, we think of it as moving out. No, you're going to move it around inside your account.
The existing account.
Accounts, if you choose to, and just move it around inside. And hopefully you have an advisor, you're working with an advisory firm that'll help you do that in a rational, frequent kind of way.
Now, Ron, with the majority of Americans saving the majority of their wealth in retirement accounts, mostly like 401ks, which are specifically designed to be automatic and out of sight, out of mind. On one hand, an advantage because the saving and investing gets done in the first place. But on the other hand, do we know, have we been taught and educated on the importance of rebalancing? Or is it a factor in the majority of our wealth and financial progress that is being ignored and overlooked?
I don't know how to answer that for the whole world or the industry. I know that when we do our periodic reviews, and we do them more than once a year with clients, we take a look at each thing that they own, how each thing is progressing. Is it doing what it's supposed to do? Is it still worthwhile holding on to? either in total or should we make a small adjustment to it? We do make those changes periodically with clients. And I think it's a wise thing to do. Of course I do. Otherwise, I wouldn't recommend it. But it's still something that I think has to happen in portfolios. Sometimes things can just get out of whack. And I guess if you wait long enough, it'll come back into whack. Can I say that? Out of whack and into whack? I just made something up. Anyhow, I suppose if you wait long enough and live long enough, it'll come back into whack, so to speak. But my position is that why do that? When we do our frequent reviews semi-annually, or even when we just call people in and say, you know, the world's changing. Why don't you come in and let's take a look at what you're doing, what your accounts are doing, and see if they're still doing what you want them to do. And see, that's the key. What is it you want your accounts to do? And are they still doing it? Because the world can change. You can own things that, man, have done really well for the last 5 years, and now they're struggling. It may be a good idea to at least take another look at that particular security and say, do I want to hold it? Do I want to fold it? Do I want to change it? It just makes good sense to stay in touch with your money, because your money is important in terms of what are you going to do when you retire? Who's going to love you then? And it's going to be your retirement money that'll do that.
Well, Ron, the next important question, do we know to do it, would be do we know how to do this? Do most people, if they are looking at their accounts, self-managing their 401k, because there's not a lot of guidance there. By the way, ladies and gentlemen, you can receive that guidance at Cornerstone Retirement Partners. But if we do not have that relationship with a proactive planning advisor, do we know how to even go in and rebalance the account?
That's a great lead in. Here's how I approach this with people, particularly clients that are getting close to retirement, say 5 years or sooner, or maybe even after retirement. The key question is my money going to last? Is my plan going to see me through to the next 30 years? That implies that it's possible and maybe probable, and maybe you have to rebalance. So we can actually create a report using some software that we have that will take a client's current investment strategy, all their assets, put them together with the income they need, any other additional income they might have, RMD kind of things, couple it with Social Security, put it all together in an income plan and say, let's see if your current strategy will last the next 25 or 30 years. Now, I don't think anybody in their right mind thinks they're going to hold the same things for the next 25 or 30 years. There's a lot of reasons for that. Some companies may not exist 10 years from now that exist today. But what we can do is we can structure this in a way that says, given what you're doing right now, this is when the plan keeps working. And at some point in time, here's where it may stop working. And if we know that, then we know that perhaps we have to circle back to what we own and take a look at the assets that we have to see if we can change them up, if we can add something that will extend the life of our retirement plan, that will extend the life of the income that we need coming in. So that's a really great way to look at this whole idea of rebalancing. It's not like we're going to move money away. We're just going to take, what do we have in this account, in our strategy? Do we have to make changes? And this isn't a change to say, well, I think in the next 6 months, gold is going to go up 40%. It's not that kind of thing. It's saying, here's what you have now. Let's just move this thing out day by day for the next 25 or 30 years and see if the plan holds up. If it does, there's no need to make a change, but we've already looked at it then, haven't we? If it doesn't hold up 10 years from now, 15 years from now, 5 years from now, then we know we have to go back and rebalance in some way. So ladies and gentlemen, if this is of interest to you, this whole idea of taking a look at your whole portfolio right now and answering a really vital question, right? Will my money last? Will I be okay? We can help you with that analysis to get that answer. So give us a call at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone.com. cornerstone-rp.com. Put your name and information in there, and we'll reach out to you, and we'll help you to get the information you need to make really good, solid financial decisions for yourself and your family.
So anytime that we are considering moving money, Ron, whether within the account, as we're talking about here with rebalancing, or maybe repositioning it to a completely different account, we have to think about the benefits and the disadvantages. So when talking about rebalancing, moving money around, shuffling it within a particular account, why is it so important? What are the advantages? What does rebalancing help us to achieve and accomplish?
Well, first and foremost, number one, what rebalancing should do, and the objective will be to put you in a stronger, more firm foundation with your investment strategy. It's as simple as that. It just says, you know what? I saw a John Wayne movie one time. He's my favorite actor. And what just struck me is he talked about how you have to call the herd, C-U-L-L. Sometimes you just have to call the herd to make the whole herd safer, bigger, and stronger. Sometimes you just have to call your investments. Sometimes you just have to get rid of the stuff that's not performing, staying with your same account, and add some things that give you a better opportunity to make progress, to achieve profit, and to make a stronger plan for you going forward. That makes sense?
It does. It does. So keeping in line with that risk tolerance, capturing profits along the way, finding and selecting the things that are helping to strengthen the portfolio and keeping that in line. I guess final note on this one, because we've got 8 on the list we want to move through today. But Ron, not only rebalancing from time to time periodically, but the allocation that we rebalance to at, let's say, 60 years old probably is not the same allocation that we would rebalance to at 30 or 40 years old. So also evaluating the allocation and rebalancing for a time optimized result.
Yeah, it really does. And there's a lot of truth to that. A 30-year-old probably has a much different portfolio than a 65-year-old. That's not always true. I've got some clients that, and it's always, I tell them, it's always your money. I'm going to do the very best to help you. But if you want to go for the gusto, I understand it, and I'll help you on that ride. But generally, it's a different portfolio. One of the interesting things about younger investors, particularly the 35 and under group, they've only really had enough money, most of them, to invest over the last 10 years. And the last 10 years have been an interesting ride in the stock market, haven't they?
A pretty good ride.
We've seen a lot of interesting things happen, and we may be seeing some supreme, profound, ugly happening this year. So a lot of it is what kind of learning experience do I have to fall back on? What kind of things do I remember that sound like, smell like, taste like what's going on? And when we've been doing reviews this year, a lot of our clients have started to say that this is reminding them of some things gone by back in the late 70s and 80s. And there's some similarity there. There's some truth there. What that does is it triggers a need to take a look and say, are we going to be okay? I had this conversation with another client last night on the phone, or Friday night on the phone. He had just come back from vacation. His key question was, are we positioned properly for what he believes is coming down the road over the next 6 to 12 months? So we went through his holdings, his whole portfolio, and we concluded that some of the changes that we've made over the past 3 or 4 months make sense. And the answer to his question, is he well positioned? The answer was yeah, and we both agreed to that. So there's no wrong time to do this kind of work. And also, it's the kind of thing that, you know, if you don't pay attention to it, it might get away from you. And you don't want that to happen. So give us a call at 616-301-2581. Go to our website, www.cornerstone-rp.com. Put your information in there and we'll reach out to you. We'll help you with information or guidance or whatever kind of help you think you need. We'll give it to you.
Again, 616-301-2581. We are talking with Ron Courser, CFP, founder of Cornerstone Retirement Partners, and today reviewing this list, this resource that you could call and request if you'd like to go over these on your own time, but 8 moments to move your money, 8 reasons why it may be beneficial to make some changes with how you're currently invested. Now, this next one, Ron, as opposed to the former rebalancing, this next item on the list, this next moment does require you to change accounts, but it may not require you to actually change what you are invested in. Roth Conversions, can you explain that for us?
One of my favorite accounts. We've spent a lot of time on this program talking about them. I'm a big fan of Roth accounts. What is a Roth IRA account? Let's compare it to a regular IRA. A regular IRA, you put money into it, you get a tax deduction, and when you take money out, you get taxed on it. It grows tax deferred. But every dollar you take out of it, it's never been taxed, you pay whatever the current tax rates are that you have. A Roth IRA, you do not get a tax deduction for putting money into it. It grows tax deferred. And when you take money out, generally you just have to follow a few rules. That money comes out tax-free. So the big issue is not so much taking money and putting it into, if you're over 50, you can put $6,000 or $7,000 into a Roth. You take money out of a CD and you got income to prove it and you put it into a Roth. The bigger issue and the harder decision for people is something called a Roth conversion. What in the world is that? That's where you take some money out of your tax deferred accounts, an IRA account, and you convert it to a Roth. What's the upside? The upside is you're taking money that's going to be taxed forever in your IRA and putting it into an account that's not going to be taxed forever, ever. What's the downside? You got to pay tax on that right now. So a lot of people like the idea of Roth conversions, but they don't like the idea of paying tax on it. And what I gently try to help people understand is we're in a pretty low tax environment right now. So if you say you don't want to pay tax now to convert some of your IRA money, you don't want to tax it now. What you're saying is that I'm going to forego my decision-making ability on when I'm going to pay tax. I'm going to turn that over to the IRS, and they're going to tell me when I have to take it out at age 72. And they're going to tell me how it's going to be taxed, given whatever tax rules they have in place. So one way to look at a Roth, yes, you're going to have to pay some tax on it now, is I'm going to keep control of when I'm going to pay the tax on it versus I'm going to forego that right that I have. And I'm going to let the IRS tell me when and how to pay the tax on all the money I have in my IRAs. So it's a big decision. It's not a decision that's made lightly simply because you're dealing with tax money. But one of the big advantages, I think, of going into this issue is to say, when should you consider it? And right now, my point of view, it's just my opinion, right now is a great time to consider a Roth conversion. Why? We've probably noticed that the value of our investment accounts have had a bit of a drop. They've lost some value because of the markets. Well, think about this. Here, I'm going to do some hand shadows on the radio, ladies and gentlemen. So put on your imaginary thinking cap and follow me along on that imaginary whiteboard inside of your brain. Let's say you have a $100,000 IRA on the 1st of January this year. It's now worth $85,000 because the market's gone down about 15 to 20%, depending on when you measure it. You can take all of that or some of that and move it to an IRA. Now, let's say within that IRA account, you have a stock you really like. You bought ABC Company at $20 a share. It went up to 50, and now it's down to 30. You're still ahead. In a Roth conversion, you can move actually individual securities from your IRA to the Roth IRA. So in this example, you're taking a security that's lost some value over the last 6 months and converting it with the idea that it's still valuable, you still want to hold it, and it's going to someday appreciate in value. So what you're doing is you're getting a bit of a tax break in a kind of a backhanded way. yes, your IRA has lost money, but you have the opportunity to transfer some or all of that at a much lower value, which means it'll be taxed at much less when you move it, convert it to your Roth IRA. So there's a lot of bad news in the economy out there, a lot of things that aren't fun, but this is one of those bright moments, I think, this little shiny object that everybody should take a look at. You're going to have to pay tax if you make the conversion, but it may make some sense given the fact that some of the values of your holdings have gone down and you can transfer an individual stock or the whole thing over. Now, here's the key thing. You just can't do this. Get up one morning and say, I'm going to transfer the IRA money to a Roth. You need the help of your advisor and your tax preparer. Now, we help our clients do this. Either we use their tax person or we use our own tax CPA here, where we do a tax analysis of any conversion amount the client is thinking about converting. You have to know these numbers because not only will it increase your tax for this year, but it could have some other effects too that have to be taken in consideration. They're not deal breakers. You just need to know it. What are those things? If you're on Medicare, this is an increase. A Roth conversion is increase in taxable income, and you have to be very aware of what you're paying on the Part B premiums in Medicare. It's very important. You don't want to have that to happen. Also, if you're not on Medicare and you have health care, Obamacare or something like that, that's also income sensitive. So you got to make sure that whenever you're doing this Roth conversion analysis, that you take all of these other things into consideration. Yes, you absolutely need to know how much more in tax you're going to have to pay on the federal, state, and local level. That's critical. But you also have to have somebody help you understand the impact on your health insurance premiums and any other costs that you may incur. But it still makes sense. Ladies and gentlemen, please take the time to think about this. Nobody likes to pay tax now, but the issue is you've got control over the tax that you're going to pay on your IRA right now if you're under 72. But if you wait, the government, the IRS, is going to tell you how much you have to take out and how it's going to be taxed. All the rules, it's all on their side. And so we become what I call ourselves victims of the IRS tax code. So we can avoid that by considering a Roth. If you want to talk more about this with us, give us a call at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com, www.cornerstone-rp.com. Put your information in there and we'll reach out to you and help you.
Very important that you quantify that, though, that you run that cost benefit analysis, and the team from Cornerstone Retirement Partners can help you weigh both the benefits and the disadvantages, the cost of making that conversion, if that's something you'd like to consider, and ultimately controlling your tax liability. Oftentimes, they see that the difference in total costs over life expectancies can be rather substantial, but it's something that you've got to weigh and determine for yourself how to address that. Most retirement assets that are tax deferred, it is a pay me now or pay me later, even generationally type of setup, but you can ultimately make some decisions, and then there are others that you cannot control. But you can make this decision with the help of a qualified, experienced professional who can quantify what that tax bill may mean for you. So again, these first two on the list of 8 moments to move your money, they need to be weighed very carefully. Rebalancing and Roth conversions may have tax implications, both of them. Rebalancing within a non-qualified account, Roth conversions certainly. So you need to understand those, but they are reasons that you can consider moving your money that may have ultimate benefits in the amount of control that you have over it. So if you'd like to find out more, or if you'd like this list to go over on your own time, pick up the phone, give a call to Cornerstone Retirement Partners, 616-301-2581, 616-301-2581. Quick break. We'll be right back with more with Ron Corser, CFP, and continue your course to retirement. And welcome back into the program, Your Course to Retirement with Ron Courser, CFP, founder of Cornerstone Retirement Partners, Grand Rapids, your resource for a common sense approach to planning for proactive savers and investors, a resource for individual and specific guidance to help make sure that your money is working hard to help you achieve your financial goals. If you've got questions or concerns, pick up the phone and give Cornerstone Retirement Partners a call at 616-301-2581, 616-301-2581. Always helpful, informative, and educational information here on the program. Today, no exception, we are reviewing with Ron Courser the report of the 8 moments to move your money. These are times, milestones, events that it may be beneficial to take a look at whether or not you should be taking a different route, moving your money. There are reasons to do so, certainly. You can't just ignore your dollars after you've put them away. You've got to make sure your dollars are working hard for you. So in reviewing this list, Ron, we've talked about rebalancing. We've talked about Roth conversions. Next on the list is a milestone, an earmark, age 59 and a half. I think that most people understand that this is the time that they can access retirement dollars and withdraw them with no pre-penalty on the money. However, there are other reasons why age 59 and a half is an important moment to consider moving your money.
It really is. A couple of reasons that come to mind, and we use it. It's the first chance people have that are in 401k plans or 403b plans to take a look at do they have a need or do they desire to have investment options that aren't offered in their current plan. 401ks, 403bs, those kind of plans, they have basically a pretty simple, clear-cut lineup of mutual funds. Most of them are geared for growth. Sometimes people want different options. Sometimes they want different investments that they want to look at. And sometimes the real key is they want more control over the money. So one of the ways to get more control over the money is when you turn 59 and a half, is to do what's called an in-service distribution. It can be called other things, but basically it allows you at age 59 and a half to move some or all of your 401k or 403b money out of your 401k plan. It's not taxed. You do it just to transfer to an IRA that you have more control over. You have greater investment options to consider, and it just brings it a little closer to home. So it's a big deal to do. By law, everybody has to be allowed to do that. Most companies allow at least some allow all of it to make these in-service distributions. But it's a way to gate control. It's a way to diversify your portfolio away from just what are primarily growth-oriented subjects, as opposed to maybe investing in specific categories. So it gives you a wide world of investment options. It gives you more control. And then you can also just deal with it on your own, either through an advisor or through yourself. And it makes it a lot easier. It gives people a sense of more control. Even if they don't want the control, they can use an advisor like us to help them. But it really is one of those important milestones where you can say, yeah, I want to control it. I want to diversify a little more. I think it makes more sense to me to move this. Now, when you do an in-service distribution, you're still in the 401k plan. You don't get out of that plan. You can still contribute. You can still get your employer match. None of that makes any difference. So it's something to consider, and I urge everybody to give that some thought. If you'd like to take a look on how this might help you, or if it even makes sense to you, doing an in-service distribution, give us a call at our office, 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. That's www.cornerstone-rp.com. Put your name, how to reach you, and we'll reach out to you and get you the information you need. You can never have enough good information to make good decisions. And that's what we try to help our clients, and hopefully you listening to today's program, to have and to do.
A couple important points on this in-service distribution availability, Ron. Even if you're still working, it may be something that you can do. In fact, that's the specific purpose of the in-service distribution. It is for when you are still working. It's likely when you don't need the money for withdrawals. We're not talking about taking income here. It's not necessarily a taxable event. In fact, if you are doing it correctly, it should not cost you anything in taxation, and you can still continue to participate and benefit from the current 401k options that you have.
Yeah, those are great points you make too. And here's another point when it comes to moving your money and when should you do it or not do it. When you make a job change, sometimes we can leave things with the old employer. Sometimes I've seen as much as 3 employers ago, and you end up with a lot of different accounts, and it's really hard to get your arms around them. So leaving an employer, it's a key time to consider moving money. What do I mean by that? Well, what are your options? You leave one employer, you can take your 401k, even if you're 35 years old, it's not a taxable issue, and just roll it into an IRA that you can control. We've already talked about some of the benefits of having your own IRA account. So that's one option. The second option is you can transfer your old 401k, if you will, to the company's 401k. You can take it to your new employer's 401k plan. And just that way you have more control. Everything's in one place. You can see what you have. And here's a third option. And this is an important option. And there's a little timeline here that we have to pay attention to. If you're 50, 55 or older, and you're separated from service some way from your employer, you can actually leave the money in your 401k plan. And here's a really golden nugget. Let's say that your employer has let you go or something's happened, you're no longer working, you're 55 or older, you're not 59 and a half. You can take money out of that 401k program that you have and not pay the 10% early withdrawal penalty because you're under 59 and a half. Why do I bring that up? Sometimes, even this day and age, we make plans that we're going to work for another 10 years, and the company comes to us and says, well, we really love you, but not that much. And you're 55 or 56 years old. Well, I'll tell you what, that's a baseball bat in the head, isn't it? But where are you going to get the income from if you're not employed? Yes, you're going to go out and look for another job. But in the meantime, you can access the money in that 401k plan because you're over 59 and a half and you're not over 55 rather, and you're not 59 and a half. That window, you can access it directly out of your 401k, just pay regular tax on it, not the 10% early withdrawal penalty. Very important to consider. I've seen and run into people when they've come into our office, they've made plan changes and they rolled it all because their ex-advisor told them, put it all in the IRA. Well, here they are, 56 years old, and they're not working. Now they've got a real problem trying to take money out of the IRA. It's possible to do it, but it's cumbersome. But keep in mind that 55 to 59 age bracket, that's where you can leave money in your 401k, access it without the 10% penalty. It's very important. Now, if you don't need income, you've gotten a new job, then you can consider just rolling it into your IRA and you control it and you make the investment decisions with the help of your advisor or us if you're our client.
But
to talk more about this, ladies and gentlemen, give us a call, 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. We can help you make really informed decisions on what's the best strategy on dealing with your 401k if you've had a job change and how old you are and what can we do to help you. So give us a call. We can help. 616-301-2581.
Ron, as we are talking about this list, this report of the 8 moments to move your money, side note here, this age 55 provision that you are speaking of, this specifically is something that you're bringing up as a moment to consider not moving your money. This only really works if we have not removed the dollars, if I understood you correctly.
Yeah, you have to leave the money in a 401k.
At least initially.
Clear? Forgive me. Yeah, you have to leave the money in a 401k. And as a certified financial planner and as a fiduciary, these are the kind of things we have to make known to our clients. If you're going to become a client of ours, ladies and gentlemen, you're going to know all the different options available to you, given whatever idea or question you have. It's our responsibility as fiduciaries to make sure that you have all the options and all the data available to you so you can make really great decisions for yourself. It's what we're supposed to do, but it's what we want to do for you. We want to be very clear to help you with the best decision possible for you, not for us. I always tell people, if you're thinking about joining our firm, understand that your money is your money. This is your money. It's not ours. We have to be on the same page as you. We have to make sure that we're doing what you want us to do, and we're doing the very best we can to reach your goals, not ours. So if this is important to you, this kind of a relationship, give us a call at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your information in there. We'll reach out to you, contact you, help you any way we can.
Again, they are your resource, ladies and gentlemen, whether it's guidance to move your money or not. These are times and milestones, events that signify you should perhaps consider moving money around. And if you need any help in making those considerations, pick up the phone, give Cornerstone Retirement Partners a call, 616-301-2581, 616-301-2581. Ron, here's one that I think a lot of people are currently worried about. Now, this may be something that, as Albert Einstein says, is all relative, but underperforming. As we've seen the market decline, a lot of people are worried about the performance of their investment portfolio. When and how should we gauge or consider moving or taking action if we feel our account is underperforming?
That's a great question. And there's been books and TV programs around this idea. So let's consider a couple things. Number one, let's just consider, first of all, a 401k or company-sponsored plan. What we see when folks bring their plans in here and we look at them is generally there'll be an S&P 500 fund, and there'll be a large cap growth fund, and maybe a second large cap growth fund. And when you really dig into it, what you find is some of these large cap mutual funds are closet S&P 500 funds. They track the S&P almost verbatim, foot by foot. They just do it. And yet the fees inside these accounts are higher than the S&P 500 fund. So one of the things to look at when you're underperforming is to find out not so much why, if you have a market-based account. There should be no surprise that if you have an S&P 500 fund and it's down this year, it's down because the market's down, and it's just going to be a market fund. But if you have a couple of the mutual funds that are large cap growth funds, for example, it may be a good idea to take a look at those, because they'll be down too. And maybe what you have is just a wonderful form of duplication, because you've got an S&P 500 fund and you have two other large cap growth funds that virtually are mirror images of each other. So one of the things you can do is you can say, I'm going to just keep one S&P kind of 500 fund. You pick it and get rid of the other two. That will help you gain clarity on what's going on in your accounts. It may help reduce some of the costs too involved, but it can help you make a better decision. If you have an S&P market-based fund and it's underperforming simply because the market is having a bad time. It's not underperforming because of what it owns, so to speak. Now, on the other hand, if you have a fund within an IRA or 401k, and the market has gone up a little bit and this fund has gone down, then you've got to take a hard look at that fund and figure out why it went down. What was going on there? Was it something in the economy? Was it something in the nature of the fund? These are the kind of things we can help folks take a look at, is not only say, well, you have these kinds of different funds, but what do you own? And what's the reason for their performance? Another issue with underperforming is that some accounts may have a lot of bonds in them. And bonds have had a tough year this year. They really have. You can have a balanced fund account or a 2030 target fund that has 40 or 50% bonds in it, and they're going to struggle this year. They really are. So there's a lot of reasons that you can have something that's underperforming. It's really important to have somebody walk you through the process of how do you find out the question to why is it underperforming? What is it doing? Once you have that question answered, you can make some good decisions on what you have to do, if you have to do anything, to reallocate your portfolio.
And of course, Ron, if we are conservative or moderate or aggressive investors, what underperforming may mean to us could be very different things.
Yeah, it's anytime I have a loss, it's underperformance. So I get that. I really do. But you have to understand that if you're going to be in the market, there's going to be volatility. And I've gone back and we've talked about this in other programs too. What can you control in investing? Think about this. I can't control the direction of the market. I know that sounds as a surprise to some people. I can't do it. But what can I control? I can control the kind of risk I'm willing to take into my life, in my portfolio and the investments. How do I do that? By understanding some of the metrics involved that we use, some of the ways we measure risk so that you can see a real number, a speed limit on the risk. So I know that I have something less that has 1/2 the risk of the S&P 500 statistical measurement. That tells me I've made a decision. If I use that investment, I'm ratcheting down the volatility. So I have control over that. I have control over as to how much I can put in individual securities, mutual funds, what have you, exchange traded funds. I have control over the kind of things I invest in. Not perfectly, but to some extent. But I can't control interest rates. I can't control the market. I can't control what's going on in Washington, D.C. So those are the kind of things I try to encourage people, and I do it in my own life too, is to just say, I'm not going to worry about those. I don't have any control over that. So I'm going to focus on what I can control. I can control the amount of investment risk I bring in. I control the amount of interest rate risk as to whether I want to hold bonds or other fixed income securities. I can control the amount of money I keep in cash. It may not grow, but it's not going to go down 15% if the market does. I can also decide to put money in principal protected accounts, like fixed index annuities that we've talked about in this program. You don't earn a lot of money on them, but over time you can expect to get 2 to 5% a year, and it is principal protected. That's an investment decision. So those are the things we can control. Don't worry about the stuff you can't control, because it'll just make you crazy. I always joke with people. My wife and I treat each other as clients twice a year. We do our semi-annual, and we're coming up here for a half-year review. And my wife, Nancy, bless her heart, I love her dearly, always looks at me and she says, "What do you think?" And my response is, "I don't know." She says, "Well, you're my financial advisor." And I look at her and say, "Yeah, but you're not paying me enough for this. You really aren't." So that's
I bet she begs to differ.
Yeah, that's the way we start out. But you know, one of the questions my wife always asks me, did we lose money? She always asks that. My wife has the memory of a giant computer. She remembers every time I made an investment in her account that didn't turn out well. And she always brings them up in these reviews. But it's what we live with. So we've gone through the ups and downs, the sideways things over the last 32 years in our marriage when it comes to the finances. And I just tell people, there's no wrong decision you can make unless you've made the decision with bad information or no information. That always gets people in trouble. It always does. You know, for a long time, we heard about, well, Bitcoin is going to take over the world. man, there's been some massive losses on those cryptocurrencies. And even Warren Buffett just kind of shakes his head. So it's important to understand who you are as an investor. And there's nothing wrong with saying, you know what? The speed limit on the expressway is 70 miles an hour. I'm comfortable going 70. I can go 95 if I want to on a nice sunny day, but I'm just going to go 70. I'm good with that. So it gets down to control what you can control. Don't worry about the things you can't control. And understand, really understand, work with an advisor who will help you understand the kinds of risk you have in your investments and what they will or will not do given whatever's going on in the world. So if any of this kind of intrigues you, ladies and gentlemen, I'd love to have the conversation with you. Give us a call at 616-301-2581, 616-301-2581, or go to our website, www.cornerstone-rp.com. Put your information in there. We'll reach out to you and help you.
Ron, I want to cover the last two on this list quickly because they are important, time limitations being what they are. Sometimes our own time is limited or changed. So another reason to consider moving your money, we've talked about the fact that there's a large percentage of the retired public that did not retire on their own timeline or of their own accord. And so if our timeline changes, then perhaps so should the approach that we take with our money.
It really should. When you're 50 years old and you think you got another 15 solid years of work, you can be maybe a little more aggressive if that's your nature. But if all of a sudden you're 53 years old and you're out of a job, or your health, something's happened with your health, and that's something we rarely talk about, and you can't work anymore full time, your time horizon has gone from 15 to 35 years down to maybe 15 months to 15 years. So when time horizons change, it's always a good idea to take a look at your investment strategy, what you own. Does it still make sense for you? Does it still make sense for you? If you are in a growth mode and all of a sudden things change and you need income out of your accounts, maybe you need to take a look at what you own and transition away from some of that growth into more income producing investments and strategies that will help you with whatever's going on in your life. Incredibly important. Understand that things change. And when things change, it's always important to say, do I have to change? Must I change? Or am I still good the way I am? And finally, the last part we get to is consolidating accounts. The most accounts I ever had with one client was 14. And they had been accumulated over time. And it was really quite an adventure for us to work together to get all the updated information, number one, and put all these accounts together. We eventually narrowed down the 14 to 3 basic accounts. One was an IRA, one was a Roth IRA, and one was a brokerage account. And all of a sudden, it became much simpler for our client to track his investments, to understand what he was owning, to understand where the income was going to come from. It just simplified his life, and he was ecstatic, and I was happy to help him. And it was kind of like it was a contest that the two of us had to see if we can fix this, and we eventually did. So, ladies and gentlemen, if you'd like to work with an advisory firm that is a fiduciary on top of everything else, first and foremost, doing what we think is everything we can do in your best interest, give us a call at 616-301-2581, 616-301-2581, or go to our website, please, www.cornerstone-rp.com. That's www.cornerstone-rp.com. Put your information in there. We'll reach out to you, see how we can help you. Give us a call.
Two final thoughts on the consolidating accounts as a reason to move your money. Number one, Ron, is that I think during retirement, we want the money to be simple. We want things from a financial standpoint to be a little easier so we can enjoy more of our time. And number two, oftentimes this does not hurt diversification. This actually helps diversification because there's overlap and duplication when you have multiple accounts many times.
That's a good point. One of the things we do that we can help people understand is what they own is we do a deep dive into their holdings, and particularly if they come with a lot of mutual funds. And every big mutual fund company, it's the same thing. It's not a criticism, it's just an observation. You can have 6 different funds from a particular well-known investment company, this kind of growth value and all that. And when you dig into them, you find out that you own Microsoft in all 6, that you really don't have the diversification you thought. And the reason is these large investment companies from BlackRock on down, they take a position in a company and then they spread those shares out throughout their different mutual funds and investment strategies. So if you really want to know you're diversified, you need to work with somebody who can do a deep dive into what you own in all those individual funds to find out if you really are diversified or not. It's important to know, because if you're not diversified internally with all these funds, you're not diversified against the market. So give us a call, 616-301-2581, 616-301-2581. We will help you if you call.
616-301-2581, Cornerstone Retirement Partners, Ron Courser, CFP, Grand Rapids, proactive savers, investors, planners, your resource. Give them a call, 616-301-2581. If you missed any of today's program, you would like this list of the 8 moments to move your money, or you think any of them apply to you, pick up the phone and give Cornerstone Retirement Partners a call, 616-301-2581. Once again, Ron, we always appreciate your time, the guidance, perspective, and education that you provide.
It's been fun, Peter. Ladies and gentlemen who've listened to the program today, have a blessed Sunday, and we'll see you next week at the same time.
Tune into Cornerstone Retirement Partners' full radio program, Your Course to Retirement, Sunday mornings at 9 o'clock at News Radio WOOD, or visit cornerstone-rp.com for many valuable resources, including those mentioned on this show and other great episodes of Your Course to Retirement.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor.
Ed Slott's Elite IRA Advisor Group is solely an indication that the financial advisor has attended training provided by Ed Slott and Company, passed biannual examinations on material covered at conferences and in webinars, and met other membership requirements, and does not constitute an endorsement of any kind. Ed Slott's Elite IRA Advisor Group members pay a fee for the educational programs that allow them to be included in the Ed Slott's Elite IRA Advisor Group. Membership does not guarantee investment success. Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services.
Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.
Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals or growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the products featured